Okay, welcome everyone. This is the State of the Market address. Thanks for joining. It's 6 o'clock. Today is Thursday, the 14th of January. Thanks everyone for joining. Today the whole point is just to get a good outlook on 2021. And the reason why we're having this is so everybody could be informed, make the best possible decisions for themselves, for the family, for their investment, their money at the end of the day, right? 2021. So we invited a great group of panelists to share exactly, what's going on in their industry. And that way, with their insight, everyone's insight, we could have a really clear picture of what we should expect this year. So thanks for everybody who is on, and I'm sure you guys are going to get a lot out of this. So let's quickly look at the outline, and that way we know exactly what we're going to do today. By the way, if you have any questions, feel free to go ahead and type it in the chat. If we're not getting to your question for whatever reason, go ahead and unmute yourself and you can go ahead and ask the question. Okay, so the first guest we're going to have is Jesse Lipscomb. He is an enrolled tax agent. He's going to be going over Prop 19, and we could ask him any questions that we have about any potential tax changes this past year that would affect us this year as property owners. And then we're going to have Robert Kelly, mortgage broker. He's going to be talking about, all the changes with COVID and Corona, how that affected the mortgage industry in 2020 and what he sees is going to happen this year in 2021. Then we're going to have Sandeep Varma. He is a finance wealth strategist, and he's going to be talking about the stock market, what happened in 2020, what's going to happen in 2021. Well, actually, we're having Philip Simmons as his proxy. And then we're going to have Dr. David Fogel. He's going to be looking at just the overall economy, the S&P 500. And we're also having Philip Simmons. So we're having both. And so that's going to be very interesting because, a lot of us have 401ks. The question always comes up, should I cash out of my 401k to purchase a home or a piece of real estate? What's going to happen to those markets? And then we're going to have AJ Gupta, attorney at law. He's going to be talking about bankruptcies, what's going on with bankruptcies, and how that's going to affect the market, right? Because if people start to file bankruptcies because of job loss or whatever, then definitely that's going to affect us. And then he's going to talk about the different real estate laws that are impacting us right now during COVID, especially between landlord and tenant relationships. I think that's going to be very interesting, and we should all definitely pay attention to that. And then I'll cap it off talking about the real estate market and what I'm seeing, what I saw in 2020, and what I feel is going to happen in 2021. So that's the outline for today. It's going to be a lot of good stuff. So if you're out there, I definitely urge you to take notes, to definitely have a notepad, and that way you don't forget this stuff. All right, so here we go. We'll start with Jesse Lipscomb. Jesse, you out there?
Hey, what's going on?
Hey,
yeah, we're here. We're good. We got a face for radio today, but we're doing good. It'll be a good presentation.
Yeah. All right. Cool.
All right, man. So check this out. I actually went in and bumped this up for you all. This is literally an hour-long presentation that SCAR had asked me to give. We're going to cover it in 10 minutes. It's going to be good. But awesome. I wanted to let you guys know of 3 tax tips too. Remember we got the stimulus checks, like $1,200 and then $600? right?
Yeah. Mm-hmm.
Well, we want to call those now recovery rebates. Okay. In fact, not recover with an R, recovery with a Y, rebates. And the reason why is that they just came out with the 2020 Form 1040, and it's right there. Okay. If you didn't get your 500, your 600, your 1,200 bucks or whatever it is, we'll be able to claim it as a rebate right there on your 1040.
Oh, really? So if the money didn't come through, you could go ahead and add it as a rebate.
Yeah, man. And there are a lot of people that didn't get rebate checks that should have. So I just wanted to share this with everybody. That, like, look, it's there, man. Like it's right there. So if you didn't get it, don't get. There's been a lot of anxiety over the last year with this stuff, and at least if you're entitled to it, it's there.
Okay, cool. Yeah, thank you for that.
And then the next one is the PPP loan. You wouldn't believe how many questions I get on this on a daily basis. It's out of control. But PPP2 is nothing like PPP1. And this is the press release that just came back from the SBA, and just the other day. Here's the fine print, okay? First draw PPP loans, pretty much you had to ask for it by August 8th of last year, okay? The second go is you have to receive the first round. You've either had to use it or you intend to use it. And now here's the kicker. You have to have at least a 25% reduction in gross receipts between any two quarters in 2019 and 2020. The bottom line is, whereas so long as you had either net self-employed earnings or you paid yourself salary in your corp, you pretty much could get your PPP loan last year. PPP2, your likelihood of getting this is pretty low, unless you're like a restaurant or something. Like if you actually had employees and your revenues were down. A lot of real estate agents, their incomes were up last year. It was a hard go to be a real estate agent for a couple months last year. But aside from that, most agents that I know actually made money last year.
Yeah, for sure. So basically the first PPP was super easy. Everybody got it. And then this next one, it's going to be very difficult to get it. Yeah. Yeah. Not impossible, but definitely different.
But they're only looking at this quarter over quarter. So, if you're down like April through June, you can because that's where we're at. Nobody was doing anything April through June. So then you could still qualify in theory.
So he's right. No, he's right. It's got to be the key words here is like this part of the sentence. You have to demonstrate a 25 reduction in gross receipts between comparable quarters 19 and 20. What that means is, let's say you had your best year ever in 2020, but that second quarter, April, May, June, you were down compared to 19. Well, then you'd be eligible to apply for the PPP. But again, what is it? It's 1/12 of your earnings times 2.5. So you take your wages from 2020, divide it by 12, multiply times 2.5. You pay yourself $24,000, divided by 12 is 2, times 2.5, it's $5,000. Okay. And what no one ever thinks about is I'll have guys that just set up a corporation, they're saving the self-employment taxes, and they'll say, oh, I want to do PPP. Well, check out this crazy math. And it's rough, but it's real. Check this out. When you set up a corporation, what you're doing is you're trying to control your Social Security and your Medicare taxes. That's commonly referred to as self-employment taxes, and it's 15.3% of your net income. So you pay yourself, say, I don't know, 60. You make 180, you pay yourself 60. Well, 15.5% with offsets, it's about $8,500. So what's the PPP loan if you pay yourself 60 grand in wages? 60 divided by 12 is $5,000. Okay. $5,000 times 2.5 is $12,500. Okay. So what I'm telling you here is, in order for you to get a PPP loan of $12,500, you're going to have to go out of your way to pay $8,500 in payroll taxes. And when you start doing the math, if you're a self-employed individual, it's a lot of extra work for not a lot of extra money.
Right. Okay, cool. Right. Well, thanks for touching on that.
Right.
So we know that one.
Yeah. And now we're into number 3. Okay, like I said, we're going to go hard and fast, but if you guys can get the big concepts, this is a big deal. And as I told SDAR, Prop 19 is better for 55-year homeowners than it is for kids inheriting mom and dad's rentals. So what I mean by that is, it's really good for you if you're a homeowner trying to upsize or downsize. And it's pretty bad for you if you're inheriting a property. Okay. So what I mean by that is, by the way, this is BOE. I mean, why make it up, right? You just go to that website, BOACA.gov, Prop 19. They've got all this stuff. It tells you what you need to know. But the old Prop 60, if you're 55, one time you could downsize, right? There's 100, basically, you sold your house for $700,000, you get another house for $700,000. You can move your property tax base for Prop 19. Awesome. Now you can upsize also. You can sell your $700,000 home and get a $1.2 million home and still not be injured as much. So let's go through an example. Okay, so by the way, we all need to know there's a difference between purchase price, assessed value, and market value. The purchase price, obviously, that's what you buy your house for. The assessed value is like what the Prop 19 value is. So here's somebody that bought their house for $32,000. Prop 19's kept it low. They're currently being assessed property taxes at $76,000. That's pretty awesome because this house is worth about $750,000. Okay, those are your 3 values. The 3 values are purchase price, current assessed value. Prop 13 keeps it low, and then what the market value is. Okay, so those are just. This is the key to understanding Prop 19 is that the current market value has nothing to do with what is being assessed at if you bought it a long time ago. Okay. So as a sales tool, you're pretty much going to come across a couple different scenarios. Scenario 1, people want to downsize. That's cool. Prop 19 is just like Prop 60. So here we have purchase price, assessed value, market price. So what happens? They sell their $754,000 home and they buy a $750,000 home. It's just like Prop 60. It's instead of being assessed at $750,000, the new home will be assessed at $76,000. I mean, that's some pretty awesome savings. God bless America. They're paying $900 a year on a $750,000 home, right? Easy. We've been doing that for a long time. But upsizing is awesome. Here, they're buying a house that's $500,000 more than the current home. Now, without Prop 19, they're going to be paying property taxes on $1.2 million, right? What Prop 19 does, it says, okay, anything over the current price gets reassessed. Well, in this case, there's $500,000 more home, right? So $500,000 will be reassessed in addition to the current assessment. So they're going to pay taxes on $576 as opposed to $1.2. That's still saving them $8,300 a year. Okay. So if your clients want to sell their primary residence, they can go up in value and go down in value. They're cool either way. Okay?
Wow. So before Prop 19, they couldn't do that, right? They couldn't upsize. They could just downsize.
That's right. That's right.
Wow.
This is a good deal. By the way, it gets better. This is a big deal, right? It gets better too because you can do it 3 times now. You can do it 3 times as opposed to once. And this is also, I mean, I kind of overlook this all the time, but anywhere in California. Back in the Prop 60 days, the uber wealthy counties up in NorCal didn't want to participate in it. Now you get somebody up in Northern California, they can downsize to San Diego and move the property tax basis. That's pretty cool, right? Just keep this one date in mind, April 1st. April 1st is the date that the 55 plus part kicks off. Up until that point, you just got to be careful. Yes, you've got 2 years to get it reassessed, but it's in the government's best interest to play games with you before April 1st. April 1st is the day it starts, right?
Got it. Understood.
So now let's talk about, and this is, oh, by the way, Voltaire, I'll give it to you. Anybody that wants it, I made Excel spreadsheets based upon Prop 19 to help you guys figure out, how it could save your clients money. But here's the inherited transfers and gifts. Look, February 15th, not April 1st, February 15th is a do or die date. And I've spoken with a ton of people since Thanksgiving on this, and I've only met one family that actually is going to benefit from this. And what I mean by that is, under current law through February 15th, if it's your primary residence, it goes to your kids, no questions asked. On February 16th, it has to be your primary residence and their primary residence, and there's $1 million cap as to what can get reassessed. Okay, so anything over $1 million of assessed value will get reassessed. Okay, and then currently, if you've got a rental property assessed up to $1 million, you can pass it on to your kids. That goes away after February 16th. So the point of it is, our super low tax rates are great while we're alive, and when we die, they're going to get reassessed, and it sucks. That's Prop 19. Okay, and if you see Propositions 58 and 193 here, the whole thing is that there are people up like in Malibu that have multi-million-dollar homes that their parents owned in the 60s that have passed on generation to generation, and they haven't been reassessed. And right now we are in a unfriendly tax environment where, the government and most of the citizens vote for raising taxes. So the bottom line is, if it's your primary residence and you're trying to pass it on to your kids, they got to live there as the primary too. Otherwise, it's going to get reassessed. Okay. Here's a scenario, right? Remember that same, right? It was assessed at 76 grand. Originally, we said it was worth 750. That's under $1 million, no problem. Here, what if it's worth 1.1? There's $1.1 million of additional assessment. So that primary residence, the first $1 million will be protected, but they'll have $100,000 added to their 76,000. So this isn't crippling. You're going to go from $940 a year to $2,100 a year. Not a big deal, but it's just, if it was a rental, it's going to get reassessed. So
I got a question for you.
The bottom line is, yeah, great.
I have a possible client. Her mother's getting older. She has a house out in La Mesa, and if she wants to stay at that tax base, if she were to use that address as her primary resident, would that cover her?
Yeah.
Okay.
Kind of. So Coach, that's that's an awesome example. So let's talk about that. If the owner of the property, right, it lives there as their primary.
Right.
Okay. And their kid is going to live there as their primary, and the assessed value is under $1 million,
it will be.
You'd be okay.
Okay.
So
and all she has to do is just change her address from where she lives now to her mother's address.
Right. Well, you're going to have to do a couple things. More specifically, she's going to have to fill out paperwork after her mom passes away, stating that yes, she swears that it's her primary.
Okay.
So the other thing is right
Jesse,
here.
we're running out of time. It's 6:20, but is there any final comments you want to give us as far as like the tech stuff?
Final thought is, for most people, it's not in the best interest of the parent to transfer the property into the kid's name while they're still alive, because the kid's going to lose the step up in basis. They're going to, potentially assess the gift taxes as well as divorce settlements while they're alive. So this is just one of those things where, I mean, look, there are some options, but they're not good options. Okay. They're not good options. As a real estate agent,
I agree.
Your ability to sell more homes because of Prop 19 exists for the following reasons. Number one, homeowners can upsize and downsize. God bless America. And when you inherit a property, it's going to get reassessed. Therefore, from a rental analysis, it's probably not going to cash flow. So if you're working with people that are inheriting wealth, the reality is you're probably going to end up selling a lot of those properties. Now, maybe you can help them sell, and then they, identify another property because they're going to have that tax-free money, which is cool. But just keep that on your radar, guys. Those are some good opportunities.
Yeah, no, that's good to know, because that may create more inventory for all the home buyers out there, right? And that might impact the real estate market. So cool. Yeah, thanks for all this. This was very informative. I took my notes.
Voltaire, is he going to send us that?
Yeah, he's going to send it to me, and then whoever wants it, I'll send it out. So
good. Thank you. Thanks, Jesse.
My pleasure.
Hey, my pleasure, guys.
Cool. Chat, what do you mean managed? I don't remember Jesse saying managed, but if you want to specify your question in the chat, we'll get that answered. All right. So next up, we have Robert Kelly, mortgage broker. He's over the mortgage industry and the changes and what to expect in the future. Robert, welcome. Thank you. And you are muted. Still muted.
That's probably a good thing in his case.
Hey, Robert, we can't hear you.
What about now?
Okay, we can hear you. Perfect. Thank you.
Good evening, everyone. I will try to go through this as fast as possible. So we're going to essentially go through what happened last year with the mortgage market and what's expected to happen this year, and what mortgages are going through as far as guideline changes, because those things impact the ability to borrow money substantially. There's been some crazy changes. So essentially what happened in 2020 is rates were at the all-time low historically. We were giving an average rates from the low twos, low threes, even for people with not perfect credit, which is essentially unheard of. Some of you guys have been in the business for about 20 years now. And I'm pretty sure if you think back to the last mortgage collapse, we were looking at rates in the high threes, low fours, and they were considered extremely low on a conventional loan, not government, but conventional, which are slightly higher than government loans. Well, now even conventional loans drop below 3% at some point. Some of them still are, but we'll see what's happening right now with the yield and bond market to give you an idea of what's going to happen with rates based on what's happening with the market. Underwriting, because of COVID, we went through a period where underwriting guidelines could change sometimes multiple times during the week, because individuals were either being furloughed, they were getting let go, they were changing jobs, they were working part-time as opposed to full-time, which led to a lot of changes in the loans that made it a little complicated in probably a 2 to 3 month period between April and June, July, to get loans. You were opening escrows, people were being, let go, and you would just have to cancel because there was no There was no solution for that, right? So we are seeing some changes even now that are being applied to our self-employed individuals. Essentially now, because the taxes that are being used to purchase are from 2019 and before, all of the 2020 income is starting to be measured for the last quarter of operations. So they're starting to dig into the last 3 months of your bank statements for your business to make sure that what you're claiming that you're making on your P&L somewhat matches what the income that you're receiving and you're depositing towards your business accounts. This started happening last week. A plus, 760 loans, 75% loan to value, saving 12% a month from their principal and interest. It's irrelevant if the last 3 months don't show that the business is producing what it's supposed to be producing. And they're coming up with these guidelines, obviously, because there's a lot of businesses that are reporting losses, or they have, even if you have a hybrid business that receives a lot of cash and deposits, if that cash is not making its way into the bank, they're going to ding you for that. Some people here that I know are aware of this, where we're going through a loan for them, and then we have to eliminate the self-employment income for that specific reason. So that's a big thing. As far as what happened in 2020, I think it was a great opportunity for people that were refinancing, that had bought in the past, that wanted to increase their cash flow or pull money out and invest in more property, more income. It was a great opportunity because a lot of them were in the 4 and 5%. So being able to refinance and cash out in the 3s or the 2s was magical to some. It's making some people a lot of money. Obviously, it's made us, the lenders, a pretty good amount of money, but most importantly, it's saving people money, which is becoming cash flow that allows them to do more things than just pocket more money, but they can also go out and acquire more assets as a result of the positive cash flow. So that was one of the most important parts of last year as far as finances. And one of the big problems that we saw last year, and we are seeing even now, is that there's a lot of appraisals that are coming in with price reductions more than before, okay, more than pre-2020. And that's because, in areas like San Diego or other premium areas where there's a lot of people buying and selling, there's so many offers that sometimes they drive the prices up, and there's nothing to support that higher price. As a result, the appraisals don't have enough comparables to give you the value that you're contracting under, which results in a negotiation that sometimes gets complicated because people want top dollar no matter what, even if the value is not there. So I'm sure some of you guys saw that, and some of the buyers that are putting offers, they're competing against offers that are over asking, that don't have any appraisal contingencies. And as a result, it's affecting them or their ability to get into a home. As far as what's happening, this is very important. This is the 10-year Treasury note, and a lot of the 30-year mortgages, which is majority of the market right now, they're driven by what happens with this Treasury note. As you can see right here, I did essentially a 12-month period. You'll be able to see that in this 12-month period, the lowest point was 0.38% and the highest point was 1.85, meaning from the beginning of last year to the beginning of this year, the 10-year Treasury has dropped from almost 2% to 1.12% right now, but they essentially dropped 75%, which is what drove the rate significantly down, okay? I did this red line that you guys can identify right here because this is the drop of the rates, this is the lowest point, and this is the trend right now, okay? So what I can tell you from that, just based on experience from many years, is that we're starting to potentially look at a rate increase. I'm not saying by any means that it will, just jump to 4 or 5% immediately, but it will ease into the market over the months from what I'm seeing, as long as the economy keeps going the way it's going right now, supported by the stimulus and everything that's going on, that's keeping, the stock prices high, et cetera. So do expect an increase in rates. At least from what we're seeing right now in the trend, it could start going down again, but from what we're seeing, it will go up because it's extremely low. Now, as far as what we can expect this year, like I said, there is higher stability from what we experienced in the second quarter of last year. However, we're not completely over the fence when dealing with the effects of COVID on guidelines for underwriting. Essentially is what I just told you that happened last week with this introduction of a lot of the investors for either brokers or direct lenders. A lot of the investors behind these entities are starting to become very cautious when lending to self-employed individuals. So that will affect the self-employment. They don't care if they reduce 20% of their pipeline because they're at, their production is extremely high regardless. So they'd rather get really clean paper with job stability for W-2 employees than self-employed people that can cook their books at any moment to qualify for a loan. That's essentially what they're trying to stay away from. Higher rates may control or may halt the price increases that we're seeing. However, there's other factors that are affecting the prices in areas such as San Diego and other big metros around the country. And is the fact that there's very low inventory and there's lack of construction. As a result, you have low inventory, prices can still go up even if rates move slightly up. However, just based on line and demand, if the money is more expensive, people will tend to have a lower purchase power, which will result in not as aggressive price hikes. But there's too many variables to tell. We can only go 1 month at a time, 1 week at a time to try to figure that out. Like I said before, rates are expected to go up, but not abruptly. That's because of national security issues. You cannot increase rates all of a sudden because then people are going to start freaking out and the market is going to come at a halt. And as you all know, people buying homes and people refinancing and cashing out and having more cash flow is what keeps the economy going, is one of the primary markets for the US, for the country. Inflation is expected. As you guys know, it's not necessarily part of lending, but the reason why I'm saying this is because as inflation increases, it will also put some pressure on individuals' finances, and that can also help retain or control some of the price hikes that could happen any minute if rates, stay extremely low. And just to finalize, in my opinion, cash flow is king. Some people will say cash is king, which is kind of like a general idea, but cash flow is king because as long as your properties, if you own properties, are producing cash flow, your books are going to be very clean and you can keep investing, or essentially any type of financing you require. When a financial institution or a bank looks at your profile, if you're cash flow positive, you will be someone that will likely have more access to finance under better terms than someone that's not. So cash flow is king. And I'm done, guys. If you have any questions or if we need to go move to someone else.
Yeah, awesome. No, thank you for that. Appreciate it. That was really good stuff. It's a crazy market here with COVID and there's always changes. So seems like you got a good pulse on the market. If you have any questions about the whole, loans, refinancing, interest rates, anything like that, just type it in the chat. We'll get to it towards the end. So that was R. Kelly, Robert Kelly. Thanks a lot. Appreciate it. So next we have Sandeep Varma, finance wealth strategist. He's going to be talking about the overall stock market. So Sandeep, welcome. Thanks for joining us.
Voltaire, thank you. It's truly my honor. Happy New Year. Happy New Year, everybody. So what a crazy year. Let me share my screen and let me jump in. So I know we're all pressed on a little bit of time. So first of all, I want to introduce this is my name is Sandeep Varma, and this is what is known as an independent financial advisor. This is actually my 30th year in business, and I am blessed with an amazing team. So A little holiday picture here, but my team is made up of some really powerful people. You're going to meet two of them. You're going to meet Philip and Dr. David Fogel, who is a genius in my mind. And you will assess that very quickly yourself after you talk to him for a few minutes. But today my focus is what Voltaire has asked me is to talk about a brief look at the equity market, on where we have come from and where we're headed. And between my team, you guys will understand. I'm going to jump in. And now, when we do financial planning, we look at the whole. We're not just one dimension. So preserving retirement planning, tax planning, and right now estate planning, and also investment. Under investment, you also have real estate. And as Roberto just mentioned, I think with low interest, it is an amazing time. And I think you're about to have some high inflation as people, as we get out of this pandemic, and people are dying to travel. And right now, people have discretionary money and they're going to overpay. There's your definition of inflation, where you have more money chasing fewer goods. And as time goes by, hopefully the vaccine will be in place. But I see inflation. And when you have inflationary situation, the two best way to hedge yourself as investors is real estate and the stock market. Those are your two best way to hedge against inflation. So a little recap at last year. Last year, we saw up in last year and the fastest recovery in the history of the stock market. From the bottom to the top, last year, the S&P 500 finished 16% up. From the bottom to the top, over 60%, which is an incredible run. When there's a lot of noise, people tend to panic. But if you just stay the course, and if you have a good, solid strategy for your family long term, you did just fine. I will tell you, out of my entire client base, which is primarily made up of San Diego and in the Bay Area, we have a pretty large client base. We had a grand total of 2 people that panicked when the drop happened and they went to cash. And they're now just getting back in. When you go to cash, it's hard to do you go back in. And I feel strongly that it's better to be in the stocks and things that you own, that you believe in, like airlines or cruises or even Disney, things that are long-term. The S&P 500 is a very popular index. It's one of the most popular index that people monitor when they're looking at investments. Now, if you take out Apple and Amazon and Microsoft, if you take out the top 24 companies of the 500 stocks that is in the S&P 500, the S&P was actually negative last year. But some of these companies, and now Tesla, which is part of the S&P 500, you have some amazing growth, and it is better to be in the market than to be out of the market. As Roberto also just mentioned, you've got the lowest interest rate. You're not getting any interest rate on any savings or checking or anything like that. It's great for borrowing money, not so much for sitting on cash. The equities, there is a huge disconnect between the stock market and what is happening right now. For example, in this pandemic, Disney is shut down. The parks are down, Disney cruises and traveling, but yet in this time frame, Disney stock is at an all-time high. How is that possible? Disney is closed. Well, they also laid off 34,000 people. And when a company lays off people, it's bad for the employee, it's bad for the local economy, it may be even bad for the local real estate because they may have to move or something. However, the company they laid off that many people. There were people who were worked for 20 years with Disney or even 30 years. So the stock market looks at as a great way of saving money for the future. Disney is doing what needs to happen to become profitable. Now, when the parks open up right now, later this year, Disney, along with other companies, are going to be more leaner, more meaner, more profitable than ever. The coronavirus, we've all heard about the amount of cases, the death, the hospitalization that are taking place. And we're really at a peak right now, especially in San Diego. This thing is not over yet, but the vaccine does bring hope. It does bring optimism, and people can look forward to it. I went hiking with a dentist a couple of weeks ago, and he was vaccinated. And he felt he felt like I should have a T-shirt that says "I'm vaccinated, get out of my way" or something. He was very high on this thing. And I have to share with you something funny. My oldest client is 103. He was vaccinated. He was one of the first people I know that got vaccinated at 103. He's in a nursing home. And his wife is 94 years old. He's mentally sharp, physically. He pushes his wife around the nursing home at 103. So he was the first person that I know that got vaccinated. Now that they've opened it up for everybody over 65, I'm trying to get my parents to get in that line now. But I think as this thing opens up, it's going to be a game changer. Now, we got to move with caution, because there's a lot of dangers ahead here. You've got a new president coming in. We're talking about a new stimulus that's going in. Now, in the last year, believe it or not, was the largest stimulus that we've ever put out there, bigger than the one that we had in 2008, real estate correction. Now, we have another one that's in the work that's about to go out there, and we're talking about increasing taxes. Right now in my client base, we are doing record amount of charitable trust. Charitable trust is a way to sell an asset, whether it's a stock or a real estate, without paying capital gain tax. We're seeing record amounts of that, but we have to be careful, because they're talking about raising income tax, estate tax, capital gain tax. And all this money is not free, that we got to pay for it somehow. The vaccine distribution is uncharted territory. Biden would like to do 100 million vaccine in 100 days. That's awesome optimism. But if we don't do that, or if there's a glitch or something along the way, it could cause a problem in the market. Trade agreement with China. There's all kinds of stuff going on over there that we're talking about. So with the new administration, again, proceed with cautious. The outlook for 21 is very positive. I mean, there's reason to be cautious, but overall with low interest rate, the two areas that is really, really good for investors is the real estate market and the stock market. And right now, I really think it's in your best interest to be fully invested and be involved with these two markets. Again, I don't have a crystal ball, but I do have 30 years of experience, and I've seen this movie, not exactly that quite like what we're going through right now, but I have a good feeling about what we can expect. So again, without knowing how the vaccine is going to play out, that plays a big role on our recovery. If CNN or the social media people find out one person that had a negative reaction to this vaccine, it's going to be all over the place, and they're going to find that one person that's going to have a problem, so proceed with caution. There's still on areas that we don't know exactly how it's going to play out. The key takeaway is discipline. If you're investing in the markets, and I know Philip is going to be talking later today, I want you to pay attention to our Maslow portfolio, and I won't take that away from him. It has done amazingly well for us. Our clients are thrilled with the way it's laid out. You're also going to hear David Fogel talk about the equity markets on where we stand. But as I mentioned, there is a disconnect with the economy and what's going on with the equity market. The economy, we have high unemployment, but the market's at an all-time high. And we could have a correction, which is healthy and needed, but long-term, this thing is going higher. And again, the effects of COVID is still is depending on clients. Cautious is the key takeaway that I want to leave you with. Make sure you have your goals. Make sure you have a good strategy in place. I will send this to Voltaire to share with you. But starting next Thursday, we have a special seminar that we're doing on Zoom called The 7 Biggest Mistakes Trustees Often Make. And right now, you want to make sure your trust is in order. I think Ajay Gupta is going to be talking about the trust side of things right now with the coronavirus. You want to make sure your healthcare powers, your power of attorney, not only for you, for your children, and also your parents, all of that is in line while all of this is going on. So those are key concerns that people have. You want to make sure all of those things are in place. So the trustee seminar is next Thursday virtually. And then after the trustee seminar, we have 4 weeks of advanced trustee workshop. And it's all complimentary through all of Voltaire's client, and we'll send all this information to Voltaire so you can receive that directly from him.
Cool.
So,
thanks a lot, Sandeep. I appreciate that. And yeah, I mean, it's those takeaways were really good. I think you know, a lot of us have 401ks, and we just got to be, you know, cautious and know exactly what's going on. So, you know, I appreciate you. And now we could go right into speak with Dr. Fogel.
Thank you very much. Let me share my screen. It's a pleasure to be with you here today.
Let me give you just... There's a lot of pressure. We heard you're a genius, so.
I love it when Sandeep does that for me. But here's my background, and then we'll get into the meat that we're going to talk about. So I've been working in artificial intelligence and mathematical things for about 35 years. My PhD is in engineering from UCSD back in 1992, and my bachelor's degree was in statistics, so that was a math degree from UC Santa Barbara. I had the very good fortune of having a father who's since passed away be one of the pioneers in artificial intelligence from the 1960s. So I got started at a very young age and had some very good footsteps to follow in. If anybody was a genius, he was the genius. But in any event, what we're going to do here is what I do with the investment committee at ATS every Friday, and also with all the clients who come in on the webinar on Tuesday. And we review the S&P 500 from a technical perspective. And so we're looking for patterns in the market that we can associate, or that others have associated statistically, with movements up, down, or sideways. And so what we're looking at the top here are the daily chart for the S&P 500. I'm sure this is familiar to many of you, but just in case it's not, so the green bars that we see here are days that the market went up, and there's a little tick on the left side and a tick on the right side, which shows the open and the close. And then on the other side of the coin, we've got the red bars, which are days that the market went down, and the same thing. So this is a one-year chart, and we can see where we are over here relative to where we were back when COVID-19 was first detected. And then that was the end of January, and then action came as the government shut down everything, and we went from somewhere around 3,300 down to a low of 2,200 very, very quickly, and have since rebounded along the way. There are some things to note there that I think are important. First of all, this orange line is an extended trend line. It goes back to when President Trump was elected, and that's it's the presidential trend line. It was a very aggressive return for the 4 years plus that he was president, plus the time that he was elected. And right here is when we had the election this time around, and you can see we've had an even faster recovery from that time. I don't expect, of course, that trend to continue. We're at probably about 4 to 4.5% for the year, and about 10% since November 3rd, give or take. So that would be a very impressive rate of return annualized, of course. So, you know, we have to take what we can get as we get it. But just to take a look at where we are now versus what we've been doing for the last 4 years. There's the 50-day moving average, which goes back about 2.5 months of trading time, with 5 days of trading per week, obviously. And we can see that that is climbing, which is a positive sign. There's the 200-day moving average, which we have in purple. You can see that's also climbing now. pretty solidly. That's also a positive sign. And when they're both going up and in parallel to each other, that's also a positive sign. We have these light blue bands, which are the Bollinger Bands, and those are created to contain about 95% of the market movement generally. And when we see the market move out of those Bollinger Bands, typically what happens is it will retrace to go back inside the bands very quickly. So you can see right here, we were below, and that would be considered oversold, and then it rebounded back inside. And you can see over here, we were very briefly overbought, but then we went all the way back to the other side of the Bollinger Bands. And the same thing happened here, and the same thing happened here, but this time we didn't go down, we just went sideways back into the Bollinger Bands. You can think about it a little bit like a pendulum or like a rubber band that's being stretched in one direction or another. It's not really a physical system, it's a result of human behavior. So these sorts of analogies tend to break down a little bit, but to give you some sort of feeling of what's going on there, it takes a little bit more effort if we want to keep stretching that rubber band and keep going further and further and further, or holding it rather than relaxing it. And that's kind of how statistically it behaves, even though it's not a physical system. And then I think the other thing to point out are the trend lines we see. So there's this one here, which is a little bit faint, but that one's no longer in play. So I try to dim these things so only the most relevant things are pertinent to us. But just so we see what happened in this period of time, there was what we call an up channel. And the channel was bounded by a resistance line on the top. Every time the market got to that line, it tended to go back down. And also a support line on the bottom. Every time it reached that support line, it tended to go back up until we crossed that. And then we started a new up channel, which was parallel to this previous one, same rate of increase, but did not get back to the previous one. And we've just pretty much slid out of that now. There are a couple of indicators down here I want to mention too, and then we'll zoom in and take a quick look and I'll tell you what the crystal ball of technical analysis does have to say here. So this is what's called the moving average convergence divergence plot. And to make it very simple to read, if the yellow line is crossing to the upside, that's a positive sign associated with the market going to move higher, more typically than not always, of course. And if it's moving down, it's more typical that the market will be moving down. And you can see that's true here also. So we had a big move up higher here, which signaled an up. And indeed, we had a long up that came. But we also had a down right here, which was just after this market turn, which signaled a little bit of a down. Instead, we got a sideways. So these are technical indicators from my research that come out about 53 to 57, 58%. It's rare to get something that's above 60% as an indicator. So we look at a mix of things and try to get an overall picture of whether there's a technically favorable result coming, a technically unfavorable, a mixed bag of results, or maybe just no results whatsoever. And in the present case so far, we've got a lot of positive technicals. The last one to look at down here is the stochastics. That's looking at whether the percentile of the price back to 20 days is at a high or a low, or coming off of that high or low. And you can see we've been off of a high, we've just come down just a little bit. And in fact, today we were down about 40 basis points. So let's quickly zoom in here, and then I'm gonna answer any questions that you might have if you have any for me. So we've zoomed in, we can see where we were. The last thing to mention, we've got some gaps. Gaps is when the market closes on a particular day and then at a particular level, and then opens at a different level, which is distant from where the previous close was, and fails to close that gap between those two values. Could be up or down, but in the last 2 months, we've seen it's just ups. 1, 2, 3, 4, 5, and another small one over here, 6, which we have not closed yet. Statistically, gaps do tend to get closed, and so those are things that are weighing on the market from a technical perspective as a pullback possibility. You can see also we were overbought here and here 2 days, and we've retraced sideways inside the Bollinger Band, so that's no longer an overbought condition. We do have a MACD looking like it might go down a little bit with today's action. Stochastics are off the top, but generally speaking, it's been very positive. So I think if we're going to sum this all up, let me see if I can get a big picture one here one more time for you. It'll come back to me. Hopefully it'll load up. It says it's loading. Hopefully it'll come back. There we are. So from the big picture, just eyeballing, obviously we've had a very strong recovery since the COVID time. A lot of that due to all the stimulus that Sandeep had been talking about. That looks to continue. We heard some more about that today from President-elect Biden with 1.9 trillion coming in, hopefully. Maybe some might say not hopefully. I guess I don't want to engender an opinion on that. Anyway, 1.9 trillion is the number, and the market reacts pretty much neutrally to that. So we have had a good run for the last 2 months. It would not be a surprise to me to have a pullback, as Sandeep was talking about. but generally the winds seem to be behind the market rather than ahead of the market at this time.
All
and
right.
happy to answer any questions you might have.
Somebody asked, do you predict market crash?
I do not predict a market crash. For the market to crash, which would mean to me that we would enter a bear market in a rapid fashion, we would have to have some external event that would be a bad event. That might be a terrorist event or a natural disaster that would be quite bad, something like that. I don't expect anything like that right now, especially since we have so much stimulus coming. It's very hard to crash the market when you've got that much money coming in.
Good. All right. Thanks for answering that. So overall, does debt matter? AJ's asking.
Does debt matter? Debt matters in the long run. Debt does not matter in the short run. You have the money in the short run.
Okay, so in the short run, it stocks. That's why stocks are good, and then they're high or whatever. But long term, we'll see the effects down the road.
Absolutely. So if we end up with somebody had asked what inflation was projected at, and I did look that up. Kiplinger has it projected at 2.2% for the year, which of course is reasonable, but it's higher than it has been, let's say. But it's reasonable. If we were to get inflation up to, let's say, higher than a Fed target, and maybe it was 4 or 4.5%, maybe higher, the Fed would be compelled to raise interest rates. And of course, as soon as there's a raise in interest rates, so we have all the effect on the bond market, but we also have the effect on paying off the debt that we have. A lot of the debt that we have now is financed with very low interest rate loans, which is great, but not all of it. And the longer we hold it and the more that we keep borrowing against it, if we were to continue to borrow against it, that would be problematic going forward. And that's really probably the biggest macroeconomic concern that I can see for the next, let's say, 5 to 10 years.
Okay. And I got a question for you, David. How serious is the debt that we have? Is it becoming an issue?
Yes, in my opinion, it is.
So we got to raise taxes then, it seems.
Yes, or cut spending, one of those two.
Right, yeah.
Or both, those are options, right?
Okay.
But the political will
and the courage
to the common person like me looking at that, I don't really see the political will to do that. So it would be easier to kick the can down the road as has been done for the last 60 years. Yes, it would seem.
Yeah. Okay.
All right. And then let's see what other questions. I think there's a there's a question for somebody to answer out here, which is a couple of things. One is thoughts on cryptocurrencies, and do you and then how do you personally react to ATHs, which I'm not sure what an ATH is.
I'm not sure what an ATH is myself either. The only thing I'll say on cryptocurrencies is I know that from ATS's perspective, we're not even allowed to comment really on cryptocurrency because it's unregulated and the broker-dealer regulations won't allow us to comment on it. So it's an unsecured speculative investment, and that's about all I'm able to say in an open forum.
Okay. I guess a better question, how many Bitcoins do you own?
How many Bitcoin do I own? I don't own any Bitcoin at all. Which I can lament in the last 2 weeks, but there are other weeks where I haven't lamented that at all. So it's how it
goes. Someone said all-time high. So ATH, what do you think about the all-time highs
for the market?
Yeah,
for the stock market.
Mm-hmm.
Well, I don't really take into account that too much as an indicator of anything. Even when I'm looking at individual stocks, so much it's more what the underlying technical patterns are. If you get to an all-time high that is engendered without technical support for it, it comes out of nowhere really without the technical support, and then of course importantly without fundamental support, then you'd have to call it irrational exuberance, and then you get worried. But as we're looking at this right here, you see an all-time high of 38.26 on the S&P from a few days ago, and technically it looks very sound. And we had other all-time highs earlier in that trend, and you could have said the same thing. So at this point, technically things look quite fundamentally good, if I can mix those two terms.
Okay, awesome. Yeah, thank you for your presentation. And now we'll move towards Philip Simmons. Philip, what up? Unmute yourself, please.
Thanks, Voltaire. Thanks for having us. Good evening, everybody.
Good evening. Okay, are you there? Do you have access to share? Yeah, I can hear you now. Yeah, you kind of cut out for a second.
Okay, but you can hear me now?
We can hear you now, yes.
Yes, famous Simmons.
It's kind of cutting out.
Appreciate you guys having us today. So I will touch on a few things. And there it is. Let's see. Let me close all this. Is that any better?
Yeah, I think we can hear you now.
Testing.
Yeah, okay, now we can hear you good. Okay, you're good.
Okay, good. So yeah, so I'm one of the advisors at ATS. Good evening, everybody. So we'll take a brief moment to talk about just investing in general, and then some of the specifics that we do here at our firm. And going forward, I know Voltaire had mentioned retirement accounts, what to invest in. Just to Sandeep's point, long-term is really the strategy you want to hold. Invest in companies that you like and that you believe in. A lot of times I suggest to clients want companies that they wear, companies that they know, that are household names. One of the portfolios that we have curated over the years, and it's been about 5 years actually this January, is our Maslow 20 portfolio. And this is 20 individual holdings that we intend to hold long-term. Some are dividend paying stocks and some aren't, but this is a Morningstar snapshot of what that portfolio looks like. This is our highest fee that we charge, and by regulation, we have to put that on there. But it's $1 million portfolio, and you can see where our stance is cautiously bullish. We are 100% invested in the U.S. stock market. Now, we do have these companies that we do hold have tentacles that are outside the U.S. However, their home base is in the U.S., and that's where we believe that. Bottom on the right-hand side, you can see the performance is as of the end of December. Okay, and portfolio return down here. If you look at the top side where it says portfolio return, this is the 1 year number. The benchmark that we're using is the S&P 500 index. So again, that's the top 500 companies in America. Our portfolio holds 20 very curated stocks. But you see the 1 year chart. We're beating the S&P 500 after that 1.45 fee that you saw at the top. We're beating the S&P 500 by 0.29. Go out 3 years, beating the S&P 500 by 3.63. 5 years, 1.77. And this 10-year figure here is what we call back testing. So that's holding these holdings going back 10 years. And you can see we're beating the S&P 500 by 3.25. One of the things I want to point out in this portfolio is first, the dividend. The S&P 500, our benchmark, has a dividend that's more close to 2%. Not only are we beating the S&P 500 in return, but the yield or the dividends is 2.5%. You can see here some of the top 10 holdings. The last thing I wanted to touch on is this figure called beta. Many of you may not be familiar with it, but beta is a measure of risk. When you look at the S&P 500, you would say you have in comparing to the S&P 500, the S&P 500 has a beta of 1. Our portfolio takes roughly 25% less risk while beating the S&P 500 benchmark. So you can see that beta is 0.74. So not only are we invested 100% in US stocks, like the S&P 500, that's 500 stocks, we are taking less risk than the actual benchmark and outperforming it. Here's a quick look at some of the companies, and I'll read them off. AbbVie, Google, Apple, Costco, General Mills, Iron Mountain, Lockheed Martin, McDonald's, Merck & Company, Microsoft, Nike, Pfizer, Procter & Gamble, Southern Company, Starbucks, Walt Disney, United Health, Verizon, Visa, and Walmart. So again, a portfolio that holds household names, companies that we believe in and we believe in holding long term is really going to be your strongest investment strategy going forward.
Cool.
Any questions?
Yes, actually, you answered someone's question. What stock categories do you recommend to invest in? And you just went off, you showed your portfolio, what you guys recommend.
Yeah, so again, the companies that you want to be looking at are companies that you believe in, companies that you're familiar with. We believe that when you own companies that you know, you're less likely to hit that panic button in situations like last March. Also, I will touch on some of the companies that you're seeing that Sandeep mentioned. The top 3 companies in the S&P 500 are all revolving around some sort of technology. Technology is a huge space and will be a huge space going forward, not just in healthcare and biotech, but also consumer technology, artificial intelligence. That's going to be a huge, huge category to be looking at, long term.
Cool. Yeah. Somebody asked, does your benchmark account for your fees?
The benchmark S&P 500, it does not account for fees. Our portfolio, so the returns that you did see, and I'll show them one more time here. This does include our this is after our 1.45 fee.
Got it. So that's after your 1.45. And then you mentioned, you kind of cut out, you said compared to the S&P 500, what was that?
So compared to the S&P 500, so the S&P 500, we don't put a fee on the benchmark, but the fee on our portfolio, 1.45, that return is net of those fees.
Got it. Okay, cool. Someone asked, do you have a good AI company to invest in?
Artificial intelligence, we haven't looked directly at that space. So I couldn't give you a company now, but our investment committee, which meets every single Friday for approximately an hour to 2 hours, does talk about various different categories. And if you want to talk further, please reach out.
Okay, I have a quick comment. Maybe you've told me a story before, or it was Sandeep, where you guys said, hey, which company would you invest in? And it was between Microsoft and Apple maybe, and I go, Apple. Why? Because Microsoft sucks. And then you're like, oh, well, Microsoft has all these other things. And I was like, I didn't even know that they had all these other things. So I think with these companies that we look at, we just look at Microsoft and think computers or software, but there's all these other things that they're involved in that we don't even know. I don't know if you want to add to that or not.
Yeah, absolutely, Voltaire. So a lot of times when we think of those huge companies, we think of, I like to use the example, and Sandeep brought up earlier, is Disney. A lot of people think Disney is just parks or cruise ships. But they tend to forget that Disney is a mutual fund in of itself. They own Marvel, Star Wars, they have a streaming service. They have all of the products that kids buy in the Disney stores at the outlets and commercially. Then they have this cruise ship, then they have the resorts, then they have the parks. So it's not a lot of these big name companies that you're looking at, that you're seeing across headlines. Keep in mind that their entire portfolio just doesn't center around one income source or one revenue source. They can sometimes, and a lot of times, are mutual funds in themselves.
Cool. And the last comment I have is, I was in Rio de Janeiro, the last 3 weeks. And I walked into a pharmacy one day and I bought some sunblock or something, and it said Johnson & Johnson. I was like, holy crap, Brazil, right? And then the next time I walked in, I got something else and it said Procter & Gamble. I was like, the heck? I mean, this is worldwide companies. They're all over. I mean, they're stationed here in the US, but it was just pretty, it was interesting.
Yeah, like I said, a lot of the companies that we have curated this portfolio, they have tentacles well outside of our borders and have so for plenty of years and going back through history, which is why we believe in them, because they've proven over 2000 crisis, the 2007 crisis, the dot-com bubbles, the 80s, all these crashes that have happened, these companies have been able to weather those storms. I did want to address, if you don't mind, there's a couple questions here I'm seeing. What's a good strategy in terms of income to invest in stocks, 5% of your income? Typically, you want to invest in including your retirement, 10% of your income. So with your paycheck, you put 10% away in retirement, and then savings outside of that, you want to build an emergency savings that's 3 to 6 months worth of savings. The other outside of that, you take and invest.
Okay, cool. 3 to 6 months of living expenses, 10% towards your retirement, and then anything on top of that, it's all gravy, it's all profit. Cool. Thank you for your time. Appreciate it. Love the presentation. Now we have AJ Gupta, attorney at law. AJ, longtime friend and teammate. we hoop together.
He says he's a better shooter than you are, Voltaire.
I don't know about that, Coach. I don't know about that. I hear Voltaire had better teachers than I did. Thanks for having me, Voltaire. Thanks. I know it's getting late, guys, so I'll try and keep this as interesting as I can. I'm an attorney, civil litigator. I deal mostly in bankruptcy and real estate matters. I like to say when the shit hits the fan, I'm the guy that's left with the toilet paper. So, like usually I'm really just good at solving hard problems. We have bankruptcy and real estate as a primary focus. My partner does corporate disputes. We have another guy that does marijuana. So we kind of cover a little bit of a gamut between the three of us. And a couple of associates that pick up the slack. Just a real quick shout out to ATS. It's a very impressive return. I talked to a fair amount of financial investors, and if you talk to them for any length of time and ask them if they can beat the S&P over the course of time, over the course of 3 years, let alone 5 to 10 years, while taking out fees, that's almost inevitably you will hear a no. So that's a really, really, that Maslow portfolio that they've put together, they must have really put a lot of thought into that. So that's a quick endorsement. And I've never met Sandeep in my life other than today. So it's just, it's an impressive feat to show that. So that's awesome. And it's a tribute to the type of people that Voltaire brings to these meetings. I'm going to do a quick screen share. I'll fly through this as well. We'll go through a couple of areas that I find interesting. And I hope this just plays for me. Go. Can everybody see this? I guess I'm just going to assume. Okay, cool. So the first question, I mean, we have this bankruptcy focus. Bankruptcy is a fun area because nobody knows anything about it except for a very small niche group of people. And, so what we want to know is what can bankruptcies tell us about where the market is going? I thought that was the most appropriate topic. And the first thing you need to understand is that bankruptcies don't tell you anything about where the market's going. Bankruptcies are always a lagging indicator, at least from the number of filings that you see. Bankruptcy happens after the problems have hit, they've tried to solve them, they've borrowed on their credit cards, their lines of credit, they've leveraged all their assets, and now they have nothing left to do but to file bankruptcy. So by its nature, bankruptcy will always be a lagging indicator. And as an indicator here, this is the total number of filings that we see in San Diego County. And it's just interesting. I like data, it's interesting. And what you can see on the right here, I don't know if I'm pointing on the right area here, but what you can see on the right here is before 2005, you pretty much saw this very, very, very consistent number with it spiking in 05. 05 was when they changed the laws to make it harder to file for bankruptcy. I don't know if you guys remember this or even care, but essentially after 05, you see the numbers drop down to 4,200 and slowly work their way back up. And so 06, really low filings. 07 was when the crisis started, the last housing crisis I hope some of you are old enough to remember this, but the last housing crisis was 07, 08, and you start to see the numbers climb there, and they go from 7,000 to 8 to 13 to 19, and then you jump over onto the other side of the screen, you jump into 2010 here, and you see it peaks in 2010, even though the peak of the crisis was really the 08, 09 timeframe. And you can see the nature of what you're seeing in terms of it being a lagging indicator. And as we start to move forward, you can see that they slowly crawl their way back down to kind of a median in 2015, and they hover around this 8,000 for a number of years. And then this year, ironically, and this does include data all the way up through November, the bankruptcy filings were actually significantly down. And that's weird because the courts were not closed. At least the bankruptcy courts were not closed. They were significantly down. You're talking about, almost 2,000 filings year over year down. I mean, you're down to 5,000 filings or 6,000 filings in San Diego County, which is an extraordinarily low number. So you start asking yourself and you scratch your head if you're like me, why? Why is it down? And you already get to this, and I know we've kind of like thrown a rock at this number at these ideas, but you have to ask yourself, what does $6 trillion mean? There's about $4 trillion that the federal government put into the economy between the PPP and the loans. Well, actually, this is actually raw money. It's not loans. It's between all of this stuff they put in terms of stimulus last year was about 4 trillion. They're putting another 2 trillion in. And there's something about the human mind that after a certain point in time, you lose track of how much $1 trillion is. So I kind of put some data points up here to make it clear. You know, the total sum of federal taxes collected in this country is 3.5 trillion. The total sum of all student loan debt, 1.7, all mortgage debt, every single piece of property that you own, your friends own, you know, the rich, the poor, all put together, 10 trillion. The total net worth of every American in the country, 98 trillion. And so like this $6 trillion that they've put into the economy in some way, shape, or form, and granted they spread it out over a bunch of stuff, it's an astronomical sum. It's an astronomical sum. 16 years of war in the Middle East was 2 trillion. In a matter of 12 months, they sprinkled $6 trillion into the economy, or commitment for another 2 trillion, which is the latest stimulus. So you have to understand what is going on as to why the bankruptcy filings are down is because it's being held up in a somewhat artificial fashion. And this is why I asked the question about debt. I do think debt matters. It's just, you know, when you can print your own money, there's all sorts of philosophies around that. I don't want to get into that. But so what we have is a situation, and I really wanted to talk a little bit, well, no, let's go back to that. All right. So that's bankruptcies. So the other thing that we look at, or the other thing that I think is important to this group, is to understand a little bit more about evictions. So evictions are really kind of the forefront of when the rubber hits the road, when it comes right down to, I guess what I would say, when it comes right down to what's going on. When you start to see people on the streets that are homeless because they're no longer in their homes, that's when people start to say, whoa, what happened here? All right. And so really up until about 4 months ago, the state and the local governments together were essentially halting all COVID-related evictions. It was a pretty blanket across the board. And then about 3 months ago, the state of California said, look, these are going to be our moratorium rules on evictions. And then overlaying that was the CDC, because the CDC is worried about health and human services. And they overlaid another layer on top of that. And so this, which I can email to anybody, my contact information is there. This is an outline of the process. And we kind of start with commercial because it's easy. All commercial evictions are going forward. So we're in the midst of several right now, both, you know, landlord side and tenant side. They're going forward as if, is that mine? Did I do that, or is that Voltaire? So anyway, all right. So evictions are going forward. Then what we have here are COVID-related evictions. And what they're trying to do is they're trying to parse out the evictions that were stayed. And this was the big problem with the blanket moratorium that they had. They're trying to parse out COVID-related moratoriums and non-COVID related moratoriums. And so, you know, if you want to evict, or if you're being evicted, I don't know who I'm talking to, but like, so if you want to evict, you have to give a 15-day notice. You have to give them an opportunity to say, hey, I'm having a hardship. And really, if they respond with a hardship, then they can continue to reside there by paying a certain amount. And it was 25% of the total amounts due. And that's going to be allowed up until January 31st. It's up until until January 31st. And that's when the rules will change on evictions. And quite frankly, like, there's nobody that's on this call with the COVID numbers where they're at that expects those numbers to go, doesn't expect this to be extended for another 3 to 6 months because the numbers are so high. And again, this serves kind of a dual purpose. One is the CDC is concerned about health and human services if there are a number of people that are on the streets. in this environment. And then on the other side of the coin, you have just the issue of homelessness, mass homelessness, all at once. And so so that's the eviction process. And then, the before August 31st is just interesting, if you had gone through that issue from before, but I don't think it really matters for the port of this thing. So what we're seeing in our practice is, and you guys probably feel this intuitively, I imagine, is really there's a group of people that were dramatically impacted. And Volt, I don't know where my timing is on this. So just, if you could
No,
just
you're good.
clue me
No,
in
you're
with
good.
it.
You're
Okay.
good. You got 5 minutes. Yeah.
Oh, perfect. Oh, I got plenty of time. So I'll slow down. So what we do is we have two groups of people, and you guys know this intuitively. In real estate, which I think a lot of you are real estate or real estate adjacent, largely wasn't impacted. And then you had, I guess, what I would call professionals. These are the programmers. These are the lawyers, the doctors. These professional services. They were actually they're doing pretty well overall in this world. The sectors that were crushed by COVID, and we can all say it's restaurant and retail, right? Restaurant and retail was absolutely destroyed. It represents about 20% of the economy and 20% of the workforce. Okay, and so these two arenas have been absolutely decimated. And they're doing their best to kind of hold bubblegum and toothpicks, hold this thing together. But a lot of those people have been unemployed, have been underemployed, and are trying to shift to new places. And the weird thing about that particular group of people is that those are the guys that typically don't invest, that typically don't have houses, that typically are the ones that are closest to being on the fringe of homelessness. And so that's what we're seeing, at least what I'm seeing in the marketplace is there is a fear that once this eviction moratorium lifts, then you're going to see a lot of people that are going to be on that homelessness fringe. And so, the response, of course, is stimulus. If we pump enough money in, then maybe, once COVID lifts, then we can kind of get this thing out of there. I'm not going to speak to the efficacy of it. I just know $6 trillion is a lot of money, but it has generally somehow made its way to real estate through low interest rates and the stock market, because those things seem to be doing just fine. But the people that are in these sectors historically are not. So, and the owners of the restaurants and the retail are not. So just be aware that that's kind of, at least from my chair, what I see going on. And it will be interesting to see how they try and spread this out, because now what you have is you have people not paying rent. And so you've got three buckets. You've got the people that aren't paying rent, right? And then you've got the landlords for the people that aren't paying rent, who are now not paying their mortgage, which, there's about 2% of Americans now are in some form of deferment, formal deferment. And then you've got the banks, all right? And so what they're trying to figure out is how to spread this pain of COVID across as equally as they can, so that no one sector gets absolutely trashed. And landlords get taken care of in theory because interest rates are low, their property values are high. Okay, it's not so bad for you. Your outlook is still positive. So anyway, that's kind of the COVID thing. There's several rules that I think have changed or are on the verge of changing that I wanted to talk about here. Student loans, we have, obviously everyone follows politics now because the grand finale was last Wednesday. So the student, now that there is a Democratic House, Democratic Senate, there's going to be a lot of change that is coming. And student loans, there's a bill that was Elizabeth Warren passed or has forwarded a bill. I don't know if it's passed, for student loans. It's independent of bankruptcy. So you should understand, like, this is going to be income dependent. At least the bill as it's situated is going to be income dependent. If you make over a certain amount, you're not going to qualify for loan forgiveness. But there's a good chance that we see some form of student loan help looking forward, because this is a hot button issue for the Democratic Party, and they are now in control, so they get to do this. I wanted to talk about Subchapter 5. Subchapter 5 is a division of Chapter 11. So there's Chapter 11 bankruptcy, which is for businesses or large estates, and Subchapter 5 is kind of this new thing that they put together, and they actually did this right before COVID, to allow smaller businesses to access the ability to restructure. So It's not terribly important, I would say, for the purpose of this, but know that it's available. The biggest issue, I don't want to go. So that's subchapter 5. There's a new homestead exemption that's effective as of January 1st. Homestead went from anywhere between $75,000 to $100,000 to up to $600,000. There is a difference between what they call a declared homestead and an automatic homestead. Again, a little bit beyond the scope of what we're going to be talking about today. Force majeure. This is, again, an interesting area of law that's evolving. I don't know if it's as relevant, but this is kind of the challenge that people have. A lot of people have personal guarantees on leases, right? If you're a restaurant owner, you've been successful for so many years, and suddenly you get COVID, you're down for a full year, you're in arrears for so long, landlord evicts, and you're responsible for it, not just the rent that you were in there, but the rent that the length of time that it takes that landlord to relet that space. And in this environment, in this economy, getting restaurants back on their feet is going to be a chore. So the personal guarantees that are associated with those, it's going to be interesting to see where that winds up in the litigation realm. But force majeure is the quote unquote act of God provision that's read into all contracts and is in many contracts explicitly. So, you know, it may be a mechanism to provide some relief to these landlords, these restaurateurs and retailers. So I just thought I'd share that. You guys covered Prop 19. I thought they did a fantastic job on that. So that's all I got for you guys.
Thanks, AJ. So the last question I have is eviction. So you're saying after January 31st, like the moratorium on evictions is going to be lifted, or you think it's going to be extended?
You got it. The way it's written right now, it's going to be lifted, but for all intents and purposes, you should expect it to be extended.
Got it. So I guess the long and short of it is if you're a landlord, your tenant isn't paying you rent, it's pretty difficult to get them out right now, if not impossible, up until January 31st, right?
Right. And like I said, I mean, they still need to pay you 25% of the rent.
Yeah.
So not saying that that's nothing, but if your landlord, if you've got a complete deadbeat tenant, you can get them out.
If they don't pay you the 25%.
And then there may be options for you on the lending side as well. Like, I mean, there's a lot of forbearance options that are out there for landlords, especially if you fall into one of these categories. The state of California has a deal with, like, I think it's close to 200 banks, 200 of the major banks, where, you know, it's almost becoming like if you ask for it, you get it. They don't even ask for financials or cause. But that's been the experience that I've had with people, is like they picked up the phone, they asked, they're like, sure, click.
Yeah.
And then come talk to us in 6 months.
Yeah, I've seen that. Someone asked, how has bankruptcy rates been affected by the passage of Obamacare?
I'll say from my personal experience, I think, you know, just doing the consumer side, like I would say before Obamacare, maybe about somewhere between 5 and 10% of the volume of bankruptcies were medical debt related. And afterward, now it's probably closer to 10 to 20% were medical debt related. And now it's probably less than 5%.
Okay, got it. All right, cool. Hey, AJ, thanks a lot. Appreciate your time. And that was a very
going right. But AJ, thank you so much for actually.
Sorry, is it me or are you guys cutting out? Is that mine?
I think Rahul's also cutting off.
Rahul and Volt just cut out pretty significantly.
Let me see. Voltaire, do you want to come and finish on my computer? I'm right next door. No, we can't hear you.
You can see me. Okay, sorry about that, guys.
Yeah.
All right.
I had a quick question. As far as forbearance, would that affect the credit score for the person accepting that?
So legally, it's not supposed to affect your credit score, but when you get your payment history, when they get that payment history, they're going to see that some of the boxes aren't checked. It's not going to say it's a missed payment, but there's going to be boxes that aren't checked for, January, February, March, the months that you don't miss your payment. So it's not, your score may not go down, but it's going to show up somewhere.
Yeah, thank you.
Cool. Thanks a lot. All right. So now we're going to go into the real estate section, which I'm going to cover. All right. So let's get right into it. All right. Share here. So this is pretty interesting what happened in real estate this year. Obviously, there's a lot of panic at the beginning of the year. I was getting a ton of phone calls. Can everybody see this real estate market update? Yeah. All right, perfect. So I was getting a lot of phone calls. A lot of people were panicking. I mean, if you go back to the beginning of COVID in March, April, I mean, everyone was panicking. Nobody knew what was going to happen with the future. So let's kind of look at what's going on right now and see if we could predict what's going to happen this year. So let's go with days on market, the time that it takes a house to sell, right? Right now we're at 36 days. Anything under 60 days is a hot seller's market. So right now we're in a hot seller's market. 36 days to sell a home compared to last year, this time, 77 days. So as you can see here, I mean, we're selling homes twice as fast. Inventory levels, right now we're at 2,556 homes active for sale. That's not a lot of homes. Same time last year, we're at 4,700 homes for sale. So we almost had double the amount of homes for sale last January. There's a question earlier, someone said, hey, is the housing market gonna crash? Should I wait to buy a home? Well, what will it take for a housing market to crash? 2009, there were 16,000 homes for sale in San Diego County, 16,000. So that's the reason why prices just got slashed in half, was because there were 16,000 homes for sale. Right now there's 2,500 homes for sale. So if you're expecting for the market to crash and you wanna wait, I mean, you need a substantial amount of homes for sale in order for the market to dip. New construction. I know, I think it was Robert that touched on this. Right now, we're at 6,600 new construction, I guess, builds that got started, or projects that got started, 6,600 in San Diego County. Compared to 2004, there's 17,000 new construction projects. 2005, 15,000. Right now, we're at 6,600. So usually in a real estate cycle, in order for it to crash, there needs to be overbuilding. Okay, usually after we overbuild, then prices start to drop because we overbuilt. Right now, we're not overbuilt. According to the Union Tribune, we're negative 35,000 housing units. So that's 35,000 families in San Diego that want to start a new household. They might be living, with their parents or with their brother or sister. So we're short 35,000 housing units. Demand. Last year, there's 15% less demanded today. So we're 15% more buyers want to buy today than a year ago. So when you look at the overall picture, 15% more buyers, there's almost like 50% less inventory than a year ago. That just pushes the prices up. Interest rates, Robert Kelly touched on that. They're between 2 to 3% compared to almost 4% a year ago. And price. Okay, so check this out. The average price home in San Diego right now is 1.7 million. I'll say that again because it's almost unbelievable. The average price home in San Diego is 1.7 million. So there's a lot of multi-million-dollar homes on the market for sale. The average home sold at the end of 2020 for 926,000. compared to the year before. It was 821,000. That's a 12% increase, $100,000 difference. Real estate just really took off. When you look at distressed homes, people in foreclosure, people that are behind on their mortgage, there's 17 foreclosures and 4 short sales available in San Diego County right now for sale. So that's 21 total distressed homes for sale right now. If you look at 2008, 9, 10, 50% of our inventory, if not more, was a property in distress. So, just looking at these numbers, it's almost hard to imagine that there's going to be any, really huge drop in real estate prices. Here is an article to the Union Tribune. The Union Tribune just put this out. Houses to rise. Can you guys see this article right here?
Yeah.
Okay, perfect. Forecast, San Diego home prices to rise 8.3% in 21, most in the nation. So right now, CoreLogic, a stats company, real estate company, they're projecting that San Diego's going to lead the nation in price appreciation, which is pretty insane. It's going to beat out Miami at 3.2%, Los Angeles at 3.2%, Washington, D.C. 2.9%. And the overall nation is going to increase at 2.5%. We're at 8.3%. So that number, that just tells you it's crazy. And I don't remember ever seeing San Diego leading the nation in appreciation, but that's where we're at right now. So that's pretty interesting. Something that Robert Kelly talked about earlier was appraisals. Right now, appraisals are in check. In 2003 to 2007, I remember appraisers, if somebody was in escrow at, 800,000 and the property is worth 700,000, the appraiser would bring it in at 800,000. And back then there wasn't regulation. So you could call your appraiser buddy, somebody and they would appraise it, and it would, so that caused the next door neighbor's house to be worth 800. And then the next month it was up for 820 and then 850. It was just shocking how fast prices were going back then. Right now, appraisers, if the property's worth 700, they're appraising it at 700 or 695. They're not playing that game because they don't want to get in trouble. There's all these regulations compared to, 15 years ago. So this market, this appreciation, it isn't the same as 2003, 4, 5, 6, 7. And, people who think the same thing is going to happen, I just can't see that happening. So the overall prediction, for the market this year on my behalf is that prices are just going to continue to go strong, go high. It's just it's a different market, and I think people that own real estate are in a good position. A couple questions. Will it be a foreclosure and short sale market? I don't believe so, Brandon. I think I just can't see that happening, even with everything that's going on with COVID, people being unemployed. 99% of all San Diegans have equity in their home. When it was a short sale market and a foreclosure market, in 2007 and 8 and 9, less than 50% people had appreciation or equity in their home. So in order for it to be short sale foreclosure market, people can't have equity in their home. And right now, everybody does, and they have high equity in their home. Someone asked, Voltaire, would you buy in this market? Yes, I bought 3 months ago. A property that I think might have been overpriced, but now I'm looking back and I thought it was a great deal. Good question. So I'm putting my money where my mouth is. Would you purchase property now, and is 3% interest rate good? Should I push for a lower rate if my credit score is exceptional? Yes, you should push for a lower rate. Definitely, you know, I think you could get something if your credit score is exceptional, you should get something at least 2.5. What do you think, R. Kelly?
It depends on the kind of financing and the loan amount, whether it's crossing the conforming threshold. So whether your loan is under, 550 or over is what's going to dictate that. If you were buying with a VA loan, you would easily be under 2.5. If you were buying with FHA, close to it or similar. Under a conventional, you could be in the high twos. Mid twos is unlikely. There's too many factors. If you're buying a home versus buying a condo, those affect. If you're buying investment over primary, it affects. There's too many variables.
Got it. Okay, so you can't answer it, but if you want, I would recommend this. Get a second opinion. Perfect. Would you recommend buying a house, a single family house, a townhouse, or units? It depends what your situation is, but if it's strictly wealth, do you want to create wealth for you and your family and generations to come? Start with units. Actually, I had great conversations with two buddies today. One started with a fourplex. Right now, he's at 46 units. He started with a fourplex, I want to say about 10 years ago. Okay, he's at 46 units. The other buddy of mine, he was begging me to move with him and do real estate in Arizona 4 years ago. So he left 4 years ago, San Diego. He's in Arizona now. He's at about 144 units, doubled his net worth. So if it's a question about should I buy a condo, a townhome, a house, or units, if it's for investment purposes, or if the long-term picture is I want to create wealth, buy units. Can you talk about investment properties? Yeah, investment properties, we went over the inventory on the overall housing market in San Diego, but investment properties right now, it's just like any other category where there's very low inventory. But I think that it's not as expensive as a single family house right now. So it's still a bit under market. Well, I don't know about under market, but undervalued compared to the single family home and condo space. And I think the reason why is because a lot of people, mostly there's just investors in that space compared to, for example, if I meet someone who was going to buy their first home, I always pitch them on 2, 3, 4 units, and they don't like that idea because they become landlords. They have to deal with tenants. They don't have privacy. So there's still opportunity, in my opinion, and we're finding deals for our buyers. It's just taking longer. So that's what's going on with investment properties there. What would you suggest to a buyer who wants to wait until after summer to buy? Which month would be best to start looking? Okay, so if you have to wait until after summer, I would just, because of interest rates and not knowing if they're going to go up or not, if the rates are good, you should just buy. Even if, usually the hottest time and the most expensive time to buy is June, July, August. But with low inventory and if rates are good, just buy during that time. I wouldn't wait until November, December.
Let me add something to that.
Yes.
Well, key, you said the summer are normally the most expensive months to buy. But yeah, so if the market is saying that prices are potentially going to go up over 8%, and if rates also move up slightly, even half a point, it's going to cost you very much to wait versus buying now. You can never know or predict what's going to happen. However, just based on trends, if prices keep going up and rates move up, you're going to pay a lot more in the summer than you would buy right now. On top of that, you'll be competing against more people because that's when they normally move due to schooling and, such things like that.
Yeah, great point. And going back to somebody asked me earlier, would you buy right now? And I said, yeah, I bought 3 months ago a property that I thought it was maybe overpriced when I was buying it. But it worked out. I'm really happy.
I bought 4 months ago. So
yeah.
Right.
Yeah, Robert bought 4 months ago. And what I've noticed is a lot of real estate professionals in the last 12 months have just been buying up real estate. Going back to one of my wealthiest clients, he's worth about $100 million. Okay, he made his chunk in the stock market. his first chunk. You know, he just knew how to pick stocks. And then he came to San Diego and he started buying up property. And then now his net worth's about 100 million. When I asked him, you know, and I talked to him from time to time and, hey, what stocks should I buy, Rick? Because he knows how to pick them. Last time I talked to him, I said, what should I be investing in? He told me residential mortgages. And I said, what do you mean invest in residential mortgages? Like, is there like a fund or something? And he said, no. Get yourself some residential mortgages because it's so cheap to borrow that money. It just makes all the sense in the world. So there you have it. There's another question. Do you recommend live in flip, wait 2 years and then sell to avoid property gains? Yes, I think that's a good idea. I think, you know, if you're looking to just make money, move every 2 to 3 years because you could use really low down payment type of financing, like first time buyer type of down payment for financing, sell the property, make your gain, and then do it again. You could do it every 2 years for the rest of your life. Do you recommend cashing out on equity and buy multi-units even though your loan increased substantially? Yeah, if you have equity, it's called a 1031 exchange. You keep always just building your portfolio. So if you have a house and you're looking to make more money, sell the house, you transfer it into 2, 3, 4 unit property. Now you have more cash flow. And yeah, maybe the interest rate is higher, but that's okay. But that's how you build wealth through real estate. AJ's leaving. Thanks a lot, AJ. Gracias, finally, Sheesh. Thank you for having us. I hope we delivered. Yeah, so everyone, thanks a lot for your time. If you have any questions, feel free to reach out to your favorite Lepe Tendwell real estate agent. If you have any questions about any of the panelists tonight, reach out to us. We'll connect you with them. And thank you everyone for your time. I know it's late. Enjoy 2021. If you want a personalized, you know, consultation, give us a call and we'll go ahead and, you know, look at your portfolio and point you in the right direction. Peace out. Thanks, everybody. You can unmute yourselves if you like.
Great job.
Thank you. Thank you.
Thank you. Have a good night.
Thank you. Thanks, R. Kelly. Thanks, Jesse. Thanks, everybody.
Welcome back, Voltaire.
Thank you.
Kelly.
Yes.
Good job on paying attention.
What do you mean?
Answering the question. You answered the question good. I'm giving you props.
What question?
The one interest rate.
Oh, come on.
Oh, yeah.
Complimented you on paying attention.
All right.
Who's left? Who's left here?
There's a lot of us. All right. We'll see each other.
Yeah,
Peace out.
And he was closing alone.
I know what that means. We got to hang up.
Your last name is Kelly.